Yes, students. I hope the previous that prepayment part is clear to you. And again, I'm telling you who taught me. When I started, for me also it was a new, brand new, just like maybe for you. More time I spend, no, I understand it. This is what my point is. Like I will always say, coaching is, see, now you need not spend much time because I told you the flow, how it happens. Even though I'm not there, you can figure it out to yourself. No, but the problem is you will take more time there. Now, again, you can do it, but you will understand it faster. Okay, so now we have done successfully. I hope we are very clear about the financial asset. So many theory was there. Now we will move on to the second aspect called a financial liability. Now let us see how financial liability is same. It is the opposite of financial asset. But our institute is not same in this stand. No, they will add one more masala there. Some garam masala, chakke or something, elakki, ilaichi or something they will add now. Now we will see what they are going to add when it comes to financial liability. So financial liability, initial recognition, transaction cost accounting, subsequent measurement. Now how do you initially recognize the, again, any financial liability has to be recognized when the entity is going to become party to the contractual provision of the instrument. There is no question of regular way purchase and sale and all. That is only for a financial asset there. The day you sign the contract, you got into financial obligation to pay cash. Financial liability, you have to pass the entry. What entry you need to pass? Whatever, I don't know what debit, to financial liability. Now second question comes, if you pass to financial liability, at what value you will measure it on the day when you first entry, initial measurement? The standard says initially you measure it a fair value. You will ask me one more question, sir, what is fair value? Transaction price is generally the fair value unless it is an off market terms. Same story. Now instrument, if it is at off market terms, then what you need to do? You have to measure the fair value. So when it is talking about the measuring the fair value of the financial liability, financial liabilities are always like debt for you. Because if it is in the form of equity, it would have been an equity, no? So there is, okay, it will be either, see, when you talk about a financial asset, there are three types of financial assets: debt, equity, derivative. But when you talk about a financial liability, there are only two types: either it is debt or it is derivative. Because if it is equity, it is equity, no? It's the third category. It is a, what is the heading? Financial liability bar equity, no? A financial instrument either will be financial asset to one party. Financial instrument is a financial asset to one party, which can be a debt, equity or derivative. It will be financial liability or equity. The liability will be only debt or derivative. Because if it is equity, if somebody is contributed to you as an equity, bank account debit, and you say credit equity, then it is an equity. So debt, generally, since it's a derivative, it's a debt maximum, majority of the case, so you always find out the present value. And if the L1 input is there, in the difference you will charge to P&L account. If you have found out the fair value by using L2 or L3 input, you may capitalize it or charge over a period of number of years. Now, no such measurement is required for equity. Equity, one entry, it is always remains the same. That means today you have passed bank account debit to equity. After 10 years also it will be the same. There is no amortization, there is no remeasurement, there is nothing. Now, how to account the transaction cost? The transaction cost, if you have classified the financial liability into FVTPL, very rare, means your objective of buying this financial liability is to sell. Generally, such type of business you will not understand. You say, sir, I'll buy an asset to sell, but what is the buying a liability to sell? Is it possible? Securitization, you take somebody's liability and pass on that liability to somebody. So by taking somebody's liability, they will pay you cash, and you sell your liability and pay less cash to somebody. Difference is your profit, no? So some people are into that business also. Somebody want to get rid of the debt, no? They can sell their liability to somebody by paying their cash. Bank says, don't see. It goes like this. You have taken a bank loan. This is you. This is a bank. You have taken a 10-year loan. After 2 years, you have got extra cash. You go and tell the bank, sir, take this cash and prepay. Just now we have done the prepayment. But bank will say, open the contract. Is there any clause called prepayment? No, no. Then you continue paying your EMI for next 10 years. I am not going to permit you. But I want to get rid of this loan. What to do? Go to another guy and say, okay, do one thing. I'll pay you one upfront cash plus 10%. Will you continue paying my EMI to the bank for next 5 years or 8 years? If he says yes, then you have sold your liability to him by making one upfront payment to third party. Now, what he can do, what is his intention to retain? Hold to pay. No, but his intention is into that business only. What he will do now, the moment he gets a liability, he will make one upfront payment to another party and say, you pay this EMI to the bank going forward. How much I'll pay? Loan value plus 8%. 2% is your margin. So people are into this business also. Sorry? Swaps also, you can say something like a swap. That's what, no, financial liability, when I say, it can be debt or derivative. Now, if you have classified FVTPL, you have to charge to the P&L account. I told you logic, because FVTPL means always you will value that financial liability at a fair value. So you end up charging P&L only. That's why I always charge to P&L. But if you amortize cost, there is no FVOCI. For financial liability, there is no FVOCI. Only for financial asset, you have got FVOCI. You will adjust with the book value. For financial asset, you will add. For financial liability, you minus. So you deduct from the financial liability. The logic is, when you pay the transaction cost, you pass the entry account in transaction cost account debit to bank. What to do with this nominal account? You transfer the nominal account to debit financial liability. In the first case, you will have in FVTPL, you say P&L account debit to transaction cost. But in the second case, since the loan is an amortized cost, you are going to prepare an amortization schedule, you say financial liability account debit to transaction cost. None of the financial asset questions we have come across transaction cost. In almost all the financial liability questions, we will have transaction. Because generally, who will incur the transaction cost? The receiver, no, not the investor. When bank gives a loan, for whom bank what it is? Financial asset. Will they incur transaction cost? No, but the receiver will. That's why now onwards you will get a flavor of a transaction cost now, which you never got. Theoretically you study, oh, there is a transaction cost. Followed, no? Now, how do you subsequently measure? What I need for subsequent measurement of a loan? How do I subsequently measure the financial liability? Then you'll ask me. Do you have any question to ask me? Then you ask me only one question, sir. What is the classification on its initial measurement? So there are three classifications. One, amortized cost as usual, FVTPL, no FVOCI for your liability, and specific basis of measurement. Now, what is my rules of classification? For my financial asset, I have got a business model test and SPPI test. There is no such test here. The standard says that by default, like FVTPL is a balancing figure, no? By default, every financial liability you amortize it. Because financial liability's nature itself is debt. There is no question of debt model, why you acquire this financial liability, you want to sell it, hold it. No, because generally 99% of the people don't acquire a financial liability to sell. But there is a possibility that people would have acquired a financial liability to sell. That's why that business model test is not applicable to a financial liability. Why? Because general practice, have you seen anybody purchasing financial liability to sell? Until I gave the example today, how it operates. Even I never came across anybody, I have not seen also in my company also, this type of transaction. That's why the default classification is amortization. Now, can you classify financial liability into FVTPL? Yes, if you are holding it for trading purpose. Or consideration is contingent in case of business combination. Oh, you have got something called a contingent consideration. Now, I am not going to explain much right now, because for this I have to explain business combination. You'll ask me what is business combination. So many stories are going to come. At that time, we'll solve the problems. I'll get connected to you again. Contingent consideration, we have to always at FVTPL. There's no amortization cost for contingent consideration, because the nature itself is contingent. If you achieve profit, I will pay you cash. How to prepare amortization for this schedule? Because my contractual cash flows are going to change now. If you don't make profit, I will not pay you. If you make 10% profit, I will pay you 10% more, 20% profit, 20% more. So amortization schedule I cannot prepare for this. Followed, no? And then if you elect to designate FVTPL, why you will designate FVTPL? Accounting mismatch. Somewhere in the own use exemption of a derivative. Now I will explain you. After this, now when we go to derivative, I will explain you. Because one of the thing is, there's a designation of FVTPL liability. Then you will understand it better. At that time, if I explain, already you are overloaded with theory on day one. It would have been too much. Then you see, slowly it will fit in everywhere. Now, if you want to do hedge accounting, what is this hedge accounting? Like for example, you have taken a loan from a bank. This is bank at a 10% fixed. What is this? Financial liability. How do you classify this? Amortized cost. You're going to prepare an amortization schedule, and every year you say interest expense, interest expense, interest expense, interest expense. Because default classification is amortization schedule, amortization, no? Now you don't want fixed loan. You go and tell the bank, sir, can you convert this fixed loan into a variable loan? Bank says, go and read the term. Have I given an option there? No. Then continue paying the fixed loan. But I want to get rid of this fixed. I don't have money to repay. This is not a prepayment. Understand? This is just I want to convert the fixed into variable. What I can do? Now I will approach swap bank, and I'll enter into one swap arrangement. I'll tell him it's called a plain vanilla swap. I'll tell him, look, I will give you fixed variable. You give me 10% fixed. Followed, no? Now what happens? Whatever fixed I have to pay to the bank, he is going to reimburse me. And whatever variable I wanted to pay, I will pay to him. Now what type of contract is this? This is a derivative contract. Now what is the designation of a derivative contract? Derivative contract may result into plus or minus. Because it's a gain to one party, loss to another party. And all derivative contract, whether you talk about asset or liability, it will land its place in FVTPL. You cannot amortize. You cannot take the derivative to a balance sheet there. It's a liability, it's the FVTPL, the fair value only. It is always fair value. Because derivative is entered with is a short term with the entering with the speculation or hedging. Now, if I have to understand only one leg, it's very difficult for me to understand. I have to understand both the things together now. Because one leg will go to balance sheet, another leg will go to P&L account. This is called accounting mismatch. Now, investors may get confused there. They will think that, oh, you must be speculating. No. Then I say, no, sir, I'm not speculating. I just converted my fixed into variable. Now, why you entered into this contract then? And it is very difficult for me to explain, because one leg of this treatment is sitting in the balance sheet. Another leg is sitting in the P&L account. That's why to avoid this, and I have to get a combined effect, because ultimately effect is nil here. So I have an option to take this into FVTPL, and this is called a designated FVTPL. An item which was about to go into balance sheet with an amortization, I will get into fair value conversion and no more amortization schedule. I will not prepare any amortization schedule. I'll just find the fair value from time to time, take the difference to P&L account. With now both coming into P&L, it will offset, gain in one, loss in another. And I can see in one place one net effect. Now you understood this example? Are you clear about this? Sorry. What goes to into P&L is the gain or loss. It's called it's the fair value change, because always derivative contracts are designated at FVTPL, means I have to find the fair value every time. It's called a mark to market. Every day or every time I have to find out the market value, define the previous market value, find the difference, charge the difference to P&L account. This is called MTM. And all the differences will go to P&L account. But here I am not interested in the market value of this. And there is an inverse relationship between interest rate and the market value. Interest rate falls, market price increases. So many things are there. See, again, it's very important, very nice from the academic point of view. Then maybe typically this concept may become a 2-hour lecture. Slowly, one by one aspect, how we go there, from there, how accounting happens, what is the implication, what is the inverse relationship between the interest rate and the bond price. Okay, if my interest rate falls, how the bond price is going to offset with this plain vanilla bond. Keep it for your professional life. Followed, no? Because 2 hours will definitely go into this in detailed discussion. But in principle, have you understood what is the accounting mismatch? Somewhere you got a fair idea. Fair is sufficient at this point of time. Fair is sufficient, no? Okay. So this is called election of designation FVTPL, and this option is available in fair financial assets also. And such designation is going to override all the classification rules. That means irrespective wherever it is going to land, no, you can bring it to P&L account. Same thing in financial assets also. Further, the fact that the liability is used merely to fund the trading activity. That means you wanted to buy one shares to do trading, buy and sell the assets. To buy the assets, you have taken a loan. That does not itself make the liability held for trading. Both are different concepts. Understand? Liability held for trading, when you say no, it is you have acquired a liability to sell. You have taken a loan to sell the loan. That is called the liability held for trading. You have taken a loan to buy an asset you want to trade. Then you can't say, sir, I have taken this liability is also held for trading. No, it's a different concept. Understood this difference? Anyhow, academic, not much relevant from the examination point of view. Now, what is that other basis? There are other bases called a continuous involvement approach. We will learn it later in detail. It's called a derecognition of the financial assets, when the financial assets do not qualify for 100% derecognition. Give me some time. Again, not relevant at this point of time. Financial guarantee contract. That means previously when you used to give guarantee, you have got one subsidiary. Parent will give guarantee to the subsidiary. It's called an off-balance sheet item. It's called a contingent liability. Balance sheet is a contingent liability. Now, will you pass any accounting entry for guarantee? But in India, you have to pass. That's why financial guarantee used to be passed at below market terms. At the market terms, forget it. It is not going to make any difference there. In such case, financial liability is measured at higher of loss allowance or initially recognized versus cumulative amount of income to be recognized. Now, what is this concept? With the problem we will solve it. I'll explain you this theory again. Why? What is the meaning of financial guarantee? What is the fair value of the guarantee? What is the loss allowance? Because without it becomes too much theoretical at this point of time. There is only one question. Even that question is not from study material, it is from your RTP, MTP. Okay, we'll solve that question so that you understand this. So this is the basis. This is the basis of measurement. So there are three bases called amortized cost, FVTPL, specific basis. 90% of the questions are revolving around amortized cost. I can say 95%, not 95, 98%. 2% of the questions are revolving around specific. That means there are only two questions. One question on specific allotment, one question on financial liability. So 98 questions, 98% of the questions are liability part. Now, how to measure equity? Measure equity initially at cost, subsequently at cost, all time at cost only. Once equity, forever equity. Why? Because it passed fixed for fixed test. No? That's why you call it equity. On day one only you know what is the amount. There is no variability there. So after 1 year, all you need to pay, I know that. So it will always remain at cost. So before we proceed into compound financial instrument, let us get a hold over the financial liability. Solving problems on the financial liability. Clear, no students? Whatever we discussed now. Anyhow, we'll recap from time to time. My objective is everything, whatever told in my chart, you have to be very clear. Because this is your revision material. After some time, no, you feel like you have forgot FR. Anyhow, my recorded lectures I'll give you. But start with the chart. You understand everything. What a chart book I have here. Means I'm going to give you. Okay, so take out the Question number 1. Okay, here initially we'll start with some examples. Issue of debt, like same thing I have classified. Bank borrowings and the financial guarantee. Okay, take out question number 17. This is my question, okay, for you to understand. How much you have issued today, a loan or bond? Because bond is a debt no for you. You have given a bond, people have invested. For them it's a financial asset, for you it's a financial liability. 50 lakh, 10% bond of 10 each. Date of issue and date of redemption. What type of bond it is? Conventional bond. Almost all financial liabilities are like conventional only for you. Term is 3 years and redemption is going to happen at 50 lakhs only. What is my journal entry and what is my amortization schedule? Okay, let us do first the journal entry part. For journal entry, what is the entry I am going to pass? What is my journal entry? Okay, tell me the 1 minute. I'll just plot the journal entry. You will tell me bank account debit. How much? Don't pass, 50 lakhs. To bond loan or whatever, you can call it any name. At what value I should have? What my standard says? At fair value. What is my fair value? That means if it's the market terms, it is 50 only. Transaction price is 50. Is it at market terms or off market terms? How do you know? How do you know it is market term? They are not given. No expectation is not there. So what will assume? Market is expecting what they are giving. Simple. Unless they tell me how on earth I will come to, will you assume 12% is expected? That is a wrong assumption. Don't take a reasonable assumption in the exam. So you assume that this must be at the market value. So let us do one thing. Let us calculate the differential M. Always initial measurement. Okay, right? Initial measurement. Initial measurement. How do I start with my initial measurement? Transaction price. What is my transaction price? 50 lakhs. Minus, what is my fair value? See, how many payments you are going to get? Or you can calculate the fair value of the loan also. I will do it here. This is my example, okay? Don't worry about the format. How many streams of payments are going to happen? Contractual obligation? 2. How much is the principal? 50 lakhs, because redemption is going to happen at a par only. Into when? 3 years down the line. What is the present value factor? 0.7513 at 10%. 1 divided by 1.1 equal to equal. And then how much is the interest you have to pay every year? 5 lakh. 50 lakh into 10%. Into present value annuity factor 2.4868. Followed, no? This will give you how much? 50 lakh. Difference is 0. This is what I am trying to tell. Means you also know now that when the transaction happens at a fair value, or market term, the fair value equal to transaction price. Because contractual cash flows, discounting factor is the contractual rate. So your accounting entry will be bank account debit to loan. You say loan. Followed, no? This is an example, just do it fast. But I want to make you understand certain things here. So my entry is same, simple, everybody will understand. Yes, if I have to prepare an amortization schedule, right? Because they asked me amortization schedule. Second, amortization schedule. I will start with the year 1, 2, 3, correct? What is my opening balance? 50. 50. Interest will be at what rate? 10%. 5. Payment is how much? 5 only. Every year interest accrued you will pay, no. three cash flows, no. And balance will be 50. So you can finish it later, fill it later. So at the end, my balance is nil. That's why you see here, when my coupon rate is equal to expected or discount rate, the contractual cash flow schedule is equal to amortization schedule. No difference at all. Otherwise, this balance would have been different, initial recognition, because it was not at a fair value. Okay? Done? Perfect? Everybody understood? No doubts? Yes, we will move on to the second question. 50 lakh is the issue price, period 3 years, but the redemption is going to happen at 60 lakhs. Now, what is my journal entry upon initial recognition? How much? Okay, first of all, bank account debit 50 you received. To loan, how much? Why? Confusion, no? Some small element came, something effective. What is my accounting entry? To loan. Loan at what value? Why? On redemption, we are getting a premium. Now, my question is, when I say bank account debit to loan, at what value I should record the loan on initial measurement? Let us go with the principle. Don't jump into conclusion. Define one sequence of analysis, so that whatever you look, that sequence, that filter is should pass through. What is my fair value? What is my fair value? Transaction is fair value. If it is at market term, then you should look, oh, is it at market term? See, understood, no students? See, this is plain question which I am giving to you. But the study material question when I come, no, then you will wonder. So two types of discount factors are given there. Whether it's an off market, at market, you are not confused. So if you don't define your way of analysis, then you will get confused there in the exam. Now you tell me, if I have to record it at a fair value, is my transaction price at a fair value? Why? No, you have to just again tell that this transaction is at market term. This is at a market term. Now, have they told you comparable loan? This is at off market. Then I'll come to that. This is never they told, no. They never told, right? So, EIR is meant to forward. Always remember, EIR is not a discount rate. EIR is an amortization rate. EIR, whenever you prepare an amortization schedule, EIR is what you are going to take. Which one? That 15.72 itself is the discount rate for you. Why? Because you need an IRR now. You need an IRR. So, your accounting entry will be bank to loan. Now, on what basis you say that 50 lakhs? You have to find out the present value of the future cash flows. How many cash flows are there? From, need not do it, 1 to 3 years. You have got interest. And third year, you have got 60 lakhs. But at what rate you are going to discount it? At what rate you are going to discount it? You need an IRR. Followed, no? Why? Because your outflow is more, no. It is not, the outflow is not the face value only. The moment outflow is going to change, you need an IRR, no? Otherwise, you will never get that. So, how do you calculate? Okay, initial entry is done because it is at the market term. See, always remember, students, you redeem at a premium, that does not mean it is an off market. It doesn't matter. At the market, because yeah, it may be at market also. The only question is, it is at the market or off market? At market. If it is at the market, this is always the journal entry. Transaction price is equal to fair value. Simple. If it is at the market, transaction price is equal to market price. Now it's the same item, same. IRR in your AFM language you call, but AFM is a different discipline, no? In accounts, we don't call it IRR, we call it effective interest rate, EIR. So in study material, you don't find the word called IRR, you find EIR. But EIR and the IRR calculations are same, it is both the same. So how do you calculate IRR now? Tell me. Because without this amortization schedule, I cannot prepare. Original entry, I don't need any EIR now. Why? Because it is at a market term. At the market term means transaction price is equal to fair value, simple. No question of discounting, no. But afterwards, I need to do an amortization schedule. For this, I need one discount rate. Now tell me how to calculate my second, you write here, second, calculation of EIR, or in bracket you can write IRR. How to calculate IRR? Then you say that you will calculate, okay, anyhow, this is an example, students, you can just for your understanding sake, because again, why we have to sit and calculate now, IRR and all. You know it, no, it's all basics. So I can say it like this, my outflow is 0, these are all my inflows. What I did, I went to the Excel, I put there XIRR is what? I got 17 points, 15.7. How to find out the IRR? You know it, no? You take 18%, you take 12%. You get a positive NPV, you get a negative NPV. Then you use this equation and calculate IRR. See, in the previous question, your IRR was same 10%. Okay, you can say first cash flow is positive, second cash flow is negative, one and the same. First will be the positive. Anyhow, this is example. Okay, you can say, yeah, first is my positive, second is all negative. Now my point 2 is, what was my EIR in the first example? 10%. Coupon rate, 10%. Why both are same? Because you got face value, you redeemed face value. But the moment the redemption is going to happen at a different rate, even though it is at a market term, the amortization schedule will be happening at EIR, otherwise your closing balances are not going to match. So, should you do it in the examination question? No. In examination question, they will tell you the EIR. Only should know the concept, what is that EIR means, where to use that, why they gave me that EIR, when already discount factor was there. That's why I am solving through an example. Understand this example thoroughly. Followed, no? So you should distinguish between discount factor, coupon rate, EIR. Because I will put more variabilities now. Now prepare an amortization schedule. I will start with the 50 lakhs. You prepare this time. But interest rate I will be charging at 15.72. Why? Because that 15 lakh rupees I pay extra, right? Sorry, how much I will pay extra? 10 lakh rupees I pay extra, no? This 10 lakhs, is it not my expense? No. Should I recognize expense only last year? How should I should amortize it. How? Change the effective interest rate, finish. So that 10 lakh will get distributed in all the 3 years. That's the logic of this EIR. 10 lakh is my cost now. Don't tell me that, okay sir, recognize, pass this NP only last year. Meaningless. No, that was there for all the 3 years. And suddenly 10 lakhs I will recognize. It's a big hit to me. Will you tell me, say 10 lakh divided by 3? No, it doesn't sound good. Because when you talk about interest, no, straight line basis of allocation is not appropriate. First question I asked you, what is amortization? So what you do, in order to expense that 10 lakh rupees into an instrument which is a market term, what you do is simply that 15% you upgrade. So what was the coupon rate? 10%, no? 10% you replace with the EIR, or which is the IR. Now when you do this, you start with 50 lakhs, you charge claiming bigger amount of interest. You compare this with the previous amortization schedule. Previous amortization schedule, what is your interest? 5, 5, 5. You have prepared previous amortization schedule, no? 5, 5, 5. How much total interest? 15 lakhs. This time how much interest you end up charging? 7.86 plus 8.3 plus 8.83, 25. So over the period of 3 years, you charge 25 lakh interest. But how much actually you're paying? 15 lakhs. So the difference between 25 minus 15 is that 10 lakh, which you pay as a premium at the end of the third year. Are you very clear about this? Is my explanation sufficient for you? You're able to get connected, Dhanashree? Understood, no? The logic is sure. Sorry? I'll explain one more. See, what I have done, previously I was paying coupon, my coupon rate is 10%. So when I am accepting face value and I am repaying you face value, and it is at market terms, my previous amortization schedule, 5 lakh, 5 lakh, 5 lakh, I charge interest every year. But since I repay 10 lakh rupees extra, and I can't pass this expense entry at the end of third year, I will increase my EIR interest rate from 10 to 15.72. And I charging 7.86, 8.3, 8.3. So when I add all the interest for 3 years, I'll get 25 lakhs. But how much you pay? 15 lakhs. So the difference between 15 and 25 is that 10 lakhs which you pay as a premium. Yes. But how much interest expense I'm claiming is 15%. Why that 15%? That 5% extra is because of the premium what I pay at the end of the redemption. Logic is what, Baba? See, simple. You go to bank and say 100 rupees FD I'll keep. How much Karnataka Bank will offer you? 100 rupees FD you keep. They will give you two options. One, they say I will pay you 10% interest every year and I will refund your principal back. Another person say I will not pay you anything every year. I will pay you 180. Which option is okay? On day one only you know. You have to choose one among the two. Now somebody says I will pay you 10%, but I will pay you 120. Which one you will choose? Say Corporation Bank says this, Karnataka Bank says this option. See, these two you have to think for time being. Which one is better for me? Forget. I will remove one of the option here like this. Now tell me, in this, which option is better for you? And everybody will take the second option. Is Corporation Bank fool there? Has put one Makmal topi on its head there. Corporation Bank is a finance guy, no? He also knows how much Karnataka Bank is offering. So what Corporation Bank will do? Will he give you 10%? He will give you 8%. He will give you less interest now, and that loss of interest he will compensate you in the form of premium on redemption. Nobody will pay you 1 rupee extra also, Baba. Forget it. Outside all finance people there, bank and all. Followed, no? Now, tell me, by entering into this arrangement, are you not fooling people out there? Telling my interest cost is low, interest cost is low. Arey Baba, where it is low? It is not actually low, because that interest cost is, you are compensating somebody at the end of third year. So that is why India says, listen, okay, I'm not going to permit this. The 20 rupees extra, you claim every year as an interest cost. That's why your coupon rate is 8%, but EIR rate is say 10% only. This is what India is trying to bring out. So by changing the EIR, you bring actual cost of interest only. Otherwise, what you will tell everyone? Oh, sir, I got a loan. How much? 10%. People will ask, how did you get a loan at 10%? For us, it is 15%. This is my capacity. You don't tell the second part of the story, that this loan is repaid with the premium there. Otherwise, no. Then if you tell that, no, I'm repaying with the premium, and then how come you are big hero? You and me same. I am paying 15% and repaying the face value. You are paying 8-10% and paying with the premium. Both are same, no. That means you are effectively, both the people interest is same, no. Understood the logic? Understood the concept? What we need to discount here? Tell me, should I discount at 10%? Then face value, this value will not be 5 lakh. Do it something. Do one thing. Let us do one thing. These are my CCF. Is it going to change? No. 5 lakh into 0.909. 5 lakh into 0.826. 5 lakh into 0.751. These three discount factors are at 10%. Can you tell me the amount? Five into 0.909 memory plus 5 into 0.826 memory plus sorry 65 no, third year class 65 into 0.751 memory plus. So memory recall, you got 57.449. Arey Baba, but you said your fair value of the loan is 50. No. If you discount these factors at 10%, your fair value will not be 50. Do one thing. You discount 65 at 15.72. What is my present value factor? 1 divided by 1.1572. See, if you do this, no, you got 0.864, 0.751 at the rate of 15%. You get 49.98. You must have got this, no? What is 49.98? 50 lakhs. So, if you want to do the present value of the future cash flows at EIR, then you get that same fair value. Then your opening entry makes sense. You're clear about this?